Yeah, when we're thinking about our portfolio construction, the first thing that we're trying to do is eliminate any risk of binary bets or things that we may get wrong, where we're humble about the fact we can't know everything. We're humble about the fact that a lot of things around the world can blindside you and you can't plan for all of that. So the first thing when it comes to how we think about cash is we want to be fully invested throughout all times in markets. And that's because it's very hard to time when you should be allocating to cash. It's very hard to time what some of the macro events might be that need you to go there. And getting that wrong for us just has a very big impact to the portfolio's performance. So we want to be fully invested in equities. We want to give our investors access to our stock picking in markets, and cash is just something that we think is a tool for the investors to choose for themselves. Yeah, when we think about the binary decisions that we're trying to eliminate, or the binary risks in markets, the first one really is actually about sectors. So when we think about that, our portfolio construction is actually quite sector neutral. So we're trying to keep our positioning in portfolios around plus or minus 5% from the benchmark weightings. But within our sector exposures, we're highly different to the benchmark. So a great example there might be in financials. So a lot of the financials within the benchmark tend to be developed market banks, but we're actually more exposed to capital markets businesses. And then within banks, we have a very big overweight to emerging market banks versus developed world banks. So for us there, what that allows us to do is eliminate some of the volatility or risks that come with getting a very big sector call wrong or right, but it allows us at a more micro level to be on the right side of change that's happening within some of these sectors. The concept of the sector rotation that's been happening, particularly since the Pfizer vaccine announcement, I think is quite fascinating, because when we think about this, often people are bringing this back to a factor. So they're thinking about growth versus value, and that value rotation we saw in the fourth quarter, when you look back, around 80-90% of that actually happened in 1 or 2 days in markets. Since that point, so even since mid-November, growth has actually outperformed. So when we think about that, we haven't rushed into just trying to play a reopening trade. We actually think there's a lot of pushes and pulls. So there's a lot of positives in markets that we're quite optimistic about, but there's some increasing negatives or things we think you need to be cautious about. So whereas in the beginning stage of 2020, we actually got a lot more aggressive in the portfolio around April, May. We increased our financials exposure by close to 10% above where we were previously to more capture some of the oversold securities we saw at the sector and stock level. But what we're doing now is we're a lot more defensive. So what that means is not outright trying to be cautious in the portfolio, but we've reduced the beta from around 1.1 more to a neutral level of around 1.0 in the portfolio, more acknowledging that at this point you want to be careful about being overly exposed to too many risks in the world, but also you want to be cautious about not having enough risk in the portfolio, because markets could still continue to rise from here. Right now, we still longer term think that it's very important, or the larger opportunity set are in these more durable growth companies. But undoubtedly, there is going to be a very large cyclical acceleration in some parts of the market that have been unloved for some time. So we still have an overweight to financials in the portfolio. More recently, we've actually been adding even to real estate, which is a sector we've traditionally been quite underweight in the portfolio. These are areas that are still underappreciated, we think, on a valuation basis, but the fundamental improvement we're going to see is far going to outweigh some of the what people deem as COVID winners that we had in 2020. Yeah, so our view on financials, we're overweight in the fund, and it's not something that's traditional of a growth manager to be overweight financials, and we haven't been historically. This is actually a position in the portfolio we took quite early in the crisis, around April, May. What we saw was a lot of these businesses heavily oversold, and people were really trying to execute the old GFC playbook. The thing here is that these businesses were not in the same situation. Financials were not the cause of this crisis either. What we saw was a very strong disconnect with the value and quality of these businesses in this cycle. And probably the best example I can recall is when we're doing research, particularly on insurers, we'd noticed that equity investors had marked these businesses back down towards GFC levels, some of them falling 40 to 60%. But when we think about the credit investors that really understand the balance sheet, they're only marking down the credit default swaps around 10%. So a huge disconnect here. We saw a valuation opportunity in the higher quality businesses, particularly in capital markets, but then we're also thinking about the inevitable recovery. We knew that stimulus was going to, in our view, protect the system from a credit cycle, and financials were a really good way to layer the portfolio or position the portfolio from an inevitable recovery and return to risk effectively. When we think about Morgan Stanley as an example, this is a capital markets business, and this is also a business that we would almost say is more of a growth company. It's definitely not a value traditional bank. So what this business is actually doing is they're actually transitioning their business away from a very capital intensive, volatile investment banking. So they do a lot of fixed income and commodity trading traditionally, and they're pivoting the business away more towards wealth management and even some more broker securities businesses as well in the retail market. So they've done some acquisitions more recently like E-Trade, and the business now we believe is going to get a more sort of quality re-rating as the business realises, or the market realises, that the business is going away from that volatile to more a recurring growth style part of the banking sector.